After the large outflows, BlackRock and the other ETFs in the past few days, it seems that we've reached the bottom. Yesterday, BlackRock had an inflow of 112 million and started buying Bitcoin, and the other ETFs together closed with the net positive of 240 million. Is this a sign that we have reached a local bottom? Should we be hopeful for a strong market reversal? Hey everyone, thank you jumping back to the Crypto Odds. Please subscribe and give the video a thumbs up. The price of DUSD has dropped from around $1 to approximately 0.03 cent, 98% decreases. The main reason for this collapse is that Elixir had allocated about 65% of the DUSD's collateral to stream finance, meaning a large portion of the backing depended on another entity. Stream Finance announced that an external fund manager lost around 93 million of users' assets. Following this crisis, deposit and withdrawal operations at the stream were halted, and Elixir also announced that it could not access a large portion of the collateral. Elixir stated that so far it has processed about 80% of the USD redemption requests, but the majority of the remainder, around 90%, is held by Stream and still faces issues. Elixir has suspended the USD minting and redemption operations until future notice, and plans to carry out a replacement or payout using USDC. This is an example of risk associated with a decentralized stablecoin or those backed by collateral that isn't fully transparent. We should be very careful when choosing our stable coins, guys. And here you are, these true stable coin. They're up 89%, 98%, like that. They are depegged. Investors have become concerned about the potential bubble in AI-based technologies. Many companies and funds are warning that valuations have far outpaced actual return potential. One of the risk is that big tech companies are forced to invest heavily in the AI infrastructure to stay competitive, but the return on investment ROI, I mean, is not guaranteed. Like Amazon, they are lays off 33,000 people to invest to heavily invest in the AI infrastructure, and there is not guaranteed to the return on investment of that. Market in the indicator also showed that the share of AI technologies in indicates like the S&P has grown significantly, and if expectations are not met, a broad market correction could occur. In other words, the combination of very high expectations plus operational and infrastructure risk equal to increased likelihood of a rapid drop in the stock prices of the companies betting on the AI. And I made a video about the AI bubble, and I hope you check it out again. I presented the evidence showing that the bubble could cause serious problems for the market. A big bubble similar to the dot-com era is likely to burst. According to the report by Challenger, Gary, and Christmas, the number of the layoffs in the United States reached 153,074 in October, nearly 3 times that of October 24, marking the highest figure for this month of the year since 2003. Additionally, total layoffs year to date have supposed 1 million, which has been reported as the highest level since the COVID-19 crisis. Meanwhile, deposit a weak labor market, the Federal Reserve has taken a more hawkish tone. In a recent conference, Fed Chair Jerome Powell stated to the Federal Reserve is disappointed with the market's expectations of an immediate rate cut in December. I've talked a lot about this topic in my previous videos. The economic situation isn't good. The number of the home buyers in the US has dropped sharply. The amount of the money people can save has decreased significantly, and public statement shows worry about the losing jobs, and the confidence in the economy is low. I hope this unemployment rate increases the chance of the rate cut in December, and that the government steps in into the prevent shutdown, so the market can regain some momentum. I hope so. And Hamak has stated that despite some sign of the easing in the labor market, inflation remains high, and in his view, and in her view, current monetary policy are not restrictive enough, or perhaps not restrictive at all. She opposed the Fed's recent decision to cut interest rates, emphasizing that there isn't significant room for future cuts unless more data shows a drop in inflation or a weakening labor market. We see that we got a very weak labor market since 2024, and Hamak predict that inflation will remain around 3% by the end of the year, and will likely stay above the 20% target in 2026. I don't think so. I'm not agree with her, meaning that expansionary policy cannot be pursued lightly. She also noted that financial conditions such as high stock prices and easy credit access are currently supportive of the economic growth, so future rate cuts could carry the risk of the increasing inflationary pressures. At this point, I'm agree with her. The increase, the future rate cut could increase the inflationary pressure, because we have the tariff, and the tariff costs to increase the inflation, and the rate cut strengthens them. So they have a two choice. First of all, they can decrease the inflation with the increasing the rate cut and continue the QT. Another choice is surviving the labor market with starting the QE, quantitative easing, and rating the cut. We need more rate cut right now at this situation for the labor market. The Bank of Japan, BOJ, decided to keep interest rates unchanged, while also signaling that there is a possibility for a rate increase in the future. The predicted chance of the Bank of Japan rate hike next month is 32% right now. I hope it remains unchanged again, because for now the Bank of Japan has been supporting the markets, the Federal Reserve policies. If you see this one, what you said, the Federal Reserve policies have only caused the distrust in the market and the economy. If in next month the BOJ surprises us with the rate hike, the market impact would be immediate. For the crypto market and the US stocks, it is very important that Japan's interest rates stay stable. Okay, jumping to the chart. Let's check the chart of the Bitcoin. If you see our weekly candle, has broke below the 50 weeks moving average. If we close the week this week like this below our 50 week moving average, then next week by any means fail to reclaim the 50 weeks as a moving average, we could face much deeper corrections. We have to next week going up to engulf this candle, or going above to the 50 weeks moving average. If we look at let's go to the lowest time frame first. Then if you look at the liquidity heat map, we have a strong liquidity zone above us around the 102 and 105,000, you see, and some below at the 98, 99,000, like this, like here. Moving to a higher, if we are moving to the higher time frame, we see, okay, we see that the most important level, liquidity level currently is around 112,000. We'll have to see if we can break above this price cluster by next week or not. I don't know. We have to reach in this level for next week. Tomorrow I will share my some of my evidence about that, why I pressure that we have to take this level for the next week.